Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Most investors rely on gut feelings, shiny brochures, or hype, and that's exactly how people miss red flags and lose money. At Break of Day Capital, we do things differently. We help investors make smarter decisions before the deal ever hits your inbox. From our educational webinars to our Invest Smart book to real tools like our portfolio tracker, we're here to give you the edge most investors don't even know they need. If you've been valuing our podcast and want to take the next step, subscribe to our newsletter. You'll get early access to webinars, new investor tools, and market insights sent straight to your inbox. Break of Day Capital, because smart investing starts before the deal.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes. Today on the podcast, we have Jon Hilley. Jon started his career at Goldman Sachs, and 3 years ago, he founded 1031 Specialists, a qualified intermediary that facilitates 1031 exchanges for real estate investors. Thanks for joining us, Jon. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, thanks for having me. This is awesome to be here and really nice getting to know you. So 1031 Specialist is a qualified intermediary. What does that mean? Okay. When you own an investment property, you have one of two choices when you sell. You can A, choose to pay up to 40% of your gains in taxes, or B, you can do a 1031 exchange. And if you do a 1031 exchange, you are required by rule to hire a qualified intermediary, someone like us, to facilitate your exchange. And really, we're an independent third party that consults with clients, produces the exchange documentation that gets them the tax benefit, and then importantly, holds onto their funds during the exchange period, because that is also a requirement of the rules.
And so on a real estate syndication, so typically, if they're going to do a 1031, it's going to be a group, or they'll do a drop and swap and maybe drop one person. Otherwise, if you're doing it on your own, you really got to have a big piece. So for us, we only accept 750,000 or more to do a 1031, like a tick into one of our deals, because it's just not worth it. The amount of paperwork and whatnot to sign on it. And so I'm curious, in your experience, have you done 1031s where you're kind of doing like the whole investment group into another deal, or?
Yeah, so with a 1031, the structure is quite important. And at the core of this is the understanding that these are deferred taxes, right? So you 1031 into one property, you do your bonus depreciation, your depreciation schedule, and then you 1031 into a higher basis property. You keep playing this playbook, right, to maximize the tax efficiency and the gains in your investment portfolio. But these are just deferred taxes, okay? They only become eliminated taxes when you die and your heirs get your property. They get a step up in basis, and that eliminates all the previous taxes that you worked so hard to, and all the gains that you worked so hard to make for them. So at some point, you're 1031ing and 1031 and 1031ing, and then you decide, you know what? I'm 75 years old. I want my money now. Okay, all those deferred taxes become taxes due and payable. And so the IRS needs a way to track all the way back to the beginning to calculate those deferred taxes. And so that's why they have this thing called the same taxpayer requirement. What that means is when you're 1031ing the same taxpayer ID, whether it's an entity or your social security number, the same taxpayer ID that's selling needs to be buying. Okay. And so with that as sort of the background and the basis, there's many different ways to sort of get there. Okay. If you are in a syndicate and everyone together is selling and then everyone together is buying, then that's no problem. Why? Because it's the same taxpayer ID that selling is buying. If you're in a smaller group, maybe, and you own an LLC with a single partner, for example, and let's say you both want to 1031, but you don't want to 1031 in the same property. That's when you would do a drop-in swap. You would go from owning an entity that owns an asset to actually being on the deed and owning the asset directly. And that's when you can then go and do your own 1031 exchange. So the point is, all of this is possible. Just sort of depends on when it comes to you and how much you're going to spend in legal fees to kind of either stay in what you're doing and continue, that's easy, or to sort of deconstruct it and all go your own separate ways.
And so let's talk about basis too, because I think people get a little bit confused on signing on the loan and the leverage and all that. Maybe can you enlighten our listeners on that?
Yeah, so I think there's three concepts that confuse certainly people that are new to 1031s quite a bit. Okay, one is basis, one is equity, and one is the net reinvestment goal to achieve full tax benefit of a 1031 exchange. Okay? And these are three very different things. So basis is the price you paid. Okay, so the original basis in the property plus capital improvements minus depreciation. And if you ever sold and didn't do a 1031, your gains are calculated from the price that you sold at, right, minus your basis. That is where you're going to pay your tax. That is a separate concept, so let's leave that on this side of the table. Equity is just your equity, right? It's the amount of cash that you're going to get out, which is your gross sales price minus fees to close, minus debt. That's your equity, okay? And so let's leave that in the middle of the table. Then you've got this thing called the net reinvestment goal, which is what you need to do to be successful at your 1031 exchange and maximize the tax deferral. So if you sell a property for $1,050,000, that's your gross contracted sales price. Okay. You're going to have about $50,000 in closing costs. I'm rounding here, but let's just make the math easy. So your net sales price, again, gross sales price minus closing costs, that is your net sales price. That is also your reinvestment goal in a 1031 exchange, which means that if you reinvest into your next property or you buy multiple properties to get to the $1 million, you will defer all of your tax. Now, you can, of course, reinvest less than $1 million, but every dollar less will be taxable to you. And so we've got a lot of clients. So that's the third concept. So we have a lot of clients that say, well, I've got quite a bit of leverage on this property. I don't know if I'm going to be able to get a new loan and execute a 1031 exchange. And so for those folks, there are other options out there like DSTs and other products that they can use to satisfy the exchange. It does make it difficult. And for people that, have $1 million property, but only 200,000 of equity and cannot go and get the extra 800K, I tell a lot of those people a 1031 exchange may not be the right fit for you actually. So for us, and what we talk about a lot is really just the net sales price, because that is the number that matters for the 1031 exchange.
Here's you mentioned DSTs. What are your thoughts on DSTs?
DSTs have gone from like 0% of the 1031 market to something like 15% in the last 15 years. So it's just like an absolute cannon shot of growth. Okay. And I think the why makes sense. Why would someone go from what they've been doing and just do a DST? Well, they may not want to manage the property anymore. They don't want to deal with the tenants. They don't want to deal with the repairs. And they're getting older in their career and they just want a passive investment. And so DST allows for that. I would just say with anything in life, I used to be a hedge fund analyst. Caveat emptor, buyer beware, do your diligence, understand all of the different fees that go into something, and make sure your eyes wide open about that investment, the sponsor that's sponsoring it, their credibility, and pay attention to the fact that maybe they have a management fee that's also involved that they own, because that's sort of a hidden way for them to kind of take out more value from the property each year. So these are just things that anybody would tell you to watch out for. But look, they're becoming really, really popular. Just be mindful of the fees. That's all.
Yeah, absolutely. I think at times people get so hung up on that tax burden. If they can't do the 1031, so they go the DSTs, where if it doesn't work, there's with bonus depreciation now back up to 100%. That's a like the lazy 1031 is a great way to go if you don't, and so you're not making an investment that you may regret down the road if the timeline doesn't work. Man, you're going to get, a massive write-off, maybe 100% of your investment. Yes, there's recapture when you sell, but boy, you're kicking that tax burden down the road just like a 1031 does anyway. So it's just it's a great backup option to have if you don't meet the timeline of a 1031 and you don't want the really high fees of a DST.
I tell clients all the time, look, what is our goal here? Our goal in real estate is to be as tax efficient as possible. Okay. And there are different ways to get there, right? One way is the 1031 exchange. The other way is with the BBB, the bonus depreciation that is now back up to 100%. These are incredible tools that everyone should be leveraging or at least exploring to maximize their investment property portfolio because compounding tax-free, whether that's through the bonus depreciation or whether that's through the 1031 exchange, is better, way better in one transaction. And it's also way better, you're way better off in a series of transactions when you compound over time. And so, yeah, 1031s are not for everyone. I would just say that you can get into a 1031 exchange. Here's what I tell investors. At the very least, hire us and get into your 1031 exchange and get into your ID period. Okay? Because what's the worst case scenario? You don't identify anything that you like within the 45-day ID period. And what's going to happen? Well, we're going to give you the small $1,200 fee back. So you basically hasn't cost you anything. And you're just there's no like additional penalty. You're just going to pay the tax as if you sold the property outright. But the 1031, getting into it at least, allows you that optionality to be as tax efficient as possible. Okay. And so to me, the most striking thing about the 1031 market generally is today only about 1 in 7 investment properties is 1031. And this is a penalty-less total free lunch that the government offers you. And yet 6 out of 7 aren't exploring a 1031 exchange. I think it's just an absolute no-brainer to at least explore it. Okay, don't go and make a bad investment decision. I would never, never, ever suggest that. Understand the fees you're paying for it, but give yourself the option of doing it. Okay.
And so when someone's going to do a 1031, how do they find a good QI? Like what separates one? What questions should they ask so they know they have someone that's a trusted partner?
Yeah, it's a great question. The market for qualified intermediaries is tiny. Okay, there's only 200 qualified intermediary firms in the entire country. There's less than 1,000 humans that do this work, myself included. Okay, and as a contrast, there are 600,000 CPAs in the US. Okay, just to give you a sense of scoping here. So the market is very small, very, very small. I think the most important thing is understand that if you're doing a 1031, you have to hire a QI, qualified intermediary. And the other big difference from any other real estate transaction is you can't take the money into your account. Okay, so at close, that equity that's left over cannot go to you. So what happens? Well, your qualified intermediary has a bank partner, and your funds are going to go and sit at that bank partner. Okay, and so ultimately, the hiring of the QI is number one: are they ultra responsive to you and your client needs before you really get into your exchange? That's a key tell, right? Do they answer the phone by the third ring? If you need them on the weekend, are they there for you? These are generally high pressure, high stress situations, and you want someone there that's available because just showing up is a lot of it. Okay. The expertise on top is the other thing. Can they be helpful even in the nuances and the edges of your 1031 exchange. But the most important thing is, what does the flow of funds look like, right? How is your money being held? Is it being pooled in aggregate with other investor funds? Or is the qualified intermediary and their bank partner spinning up a separate, segregated account where your funds sit, don't get invested in anything, they just sit there until they're ready to purchase your replacement property? So these are all the areas that I would be focused on. Ultimately, what's interesting to me is, we get calls every week from people that are in their exchange with another QI. They're already in the middle of their timelines. And they call us because their qualified intermediary is not answering their phone or their email. And so I find it bizarre, but really the cornerstone of what we're building here and why my firm is, we're taking market share every day. We're growing kind of sort of up and to the right as any good chart would be. And I think that's largely because we really care about the client experience, right?
I gotta tell you, a couple of people recommended some QIs in the past, over the past few years, and I've reached out to them, and I wouldn't get a phone call back. So I know exactly what you're talking about. Like trying to find a good one that is, the bar sometimes is pretty frustrating.
It's like these. I don't know what it is about these financial services niches, but it's hard to get your CPA to call you back too. It's just like
Yeah.
there is the people that do the work don't appreciate that so much of it is about the client service level and the client experience. So much of that is just about being responsive, And so it's interesting to me as an entrepreneur now building this firm that the bar is really low, and people aren't reinvesting in their business. They're not reinvesting in the client experience in the ways that we are. So.
Earlier in our conversation, you mentioned costs, and I think you said it was a little over $1 million, maybe 50,000 costs, but I think that includes like escrow and title and whatnot. So if you're coming into a tick, we're already doing all those things anyway. So the piece that it's costing the 1031 person is relatively small. I don't, what is there a percentage, like how is your fee structure?
Well, again, that has nothing to do with the 1031 fee. Our fees are tiny, right? But most of the cost for our clients are, they're selling a multifamily building that they own, and 95+% of the costs are the broker sell it, right? And so if you don't have that broker fee, then your costs are title escrow and 1031 qualified intermediary fee. And those are de minimis, truly. I mean, they don't scale with the percentage of the price of the property. They're just tend to be small flat fees. I mean, our fee is $1,200, and I assure you, there's 144 steps to go from like new client to completed exchange. So you can do the math on $1,200 divided by 144 steps, and you'll see what that looks like for us. But yeah, the title and escrow fees are generally de minimis too.
No, I'm glad I clarified that, because when I saw, it's very minimal for something that you're massively deferring taxes. So I do read sometimes that 1031s do get blown up and for mistakes or whatnot, but maybe talk about that. What are some things to look out for?
Like everything about a 1031 can be, I would say almost everything about a 1031 gets solved with proper planning. Okay, so you don't need to wait. The timelines don't start the day you sign a for sale contract. Like when you sign the PSA, clock hasn't started yet. The clock only starts the day that you transfer title on your properties, the day that you close. And so you have all that time really in advance of the clock starting to plan and prepare ahead. And for us, the best, most consistent advice we give to clients is, use this time wisely. Treat this like it's your full-time job, because the tax savings are truly a 1-year salary for a lot of people, right? And so if you want to pay $300,000-$400,000 next year when you file your taxes because you sold this building, or do you want to put in the extra work over a couple of weeks to diligence what you want, get a trusted partner like you, right, that is going to do the work for them and acquire that asset and defer all of those taxes. I think people are quite surprised, particularly living in a place like New York or California. They think, oh, I'm just going to pay like 15, 20% capital gains. No, you're not. There's 4 levels of tax that hits you when you sell. I should say up to 4 levels of tax that hits you when you sell an investment property. That's the federal at 15 or 20. That's the state tax, which could be 0 in Florida, but could be 13.3% like in California. There is this thing called net investment income tax, which is 3.8% if you make over a certain amount of money. And then finally, the one most people forget is depreciation recapture. And that one will get you, because you can actually lose money on the sale of your building, but still pay hundreds of thousands in depreciation recapture. But all 4 of those taxes get deferred in a 1031 exchange.
You made a great point about planning ahead, which most people kick the can. They're like, oh, well, I'll wait until it sells, and then I'll start figuring out. Man, a deal could take 2-3 months in escrow before you close. Take advantage of that time to find a deal or network or whatnot, because deals take a long time to close, and particularly once you close on that, finding a deal and closing on that could take a very long time with a new loan or whatnot. So yes, proper planning is so key for everything you do, and a lot of people skip that piece.
I mean, the way I think about it, Gary, is like, you sell your house on Tuesday, okay, the house you live in. Does that mean on Wednesday you're homeless? Right? I mean, of course not. You had planned ahead. You thought about where you're going to live next, whether you're going to, move in with family for a couple of short weeks, or you're going to rent this apartment, or you're going to buy this new house. Like, that is all part of the sales process when you're selling your primary house. In an investment property, it's you got to treat it the same way, right? And the worst thing you can do is not have the optionality of getting into a 1031. The second worst thing you can do is just not getting the right people around you, the right advisors, the right help to acquire. All that, there's tons of people out there. I mean, your firm, right, that is out there helping put investors in properties that are diligent. And that is those are essential elements to being successful.
Hey, John, is there anything else I didn't ask about 1031s that a newbie should know about out there?
It's really simple. Okay. Hire a QI, hit 2 deadlines, buy a replacement property within 6 months. You get 6 months to close on your replacement property. It is very simple. There is depth and nuance and hard things about 1031 exchanges, but at the core, it's a really simple bit of the tax code. And I think it's an underutilized tool for so many. And the thing we're really doing, we're partnering with the National Association of Realtors and other organizations to educate members and educate investors and professionals here about how simple this actually is, and how great it can be when you do a few of these trades, and you can do the math on paying tax each time versus tax deferral each time. And you're going to be millions of dollars richer just in a handful of trades, right? So it's real. Lean into it.
Well, John, I appreciate you coming on the show and adding a ton of value on 1031s. Where can listeners find out more about you and your company?
Yeah, so 1031 Specialists is the name of my firm. That's 1031 Specialists with an S at the end.com. Call us anytime. Call us on the weekends. You're gonna understand what client service means, because we'll answer the phone. And that's 631-GET-1031. So it's 631-438-1031. And anytime, we're happy to help.
Awesome. Thank you so much. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.